Hello, Jeremy Harper here, mortgage broker. Today we're going to talk about the concept of debt recycling and how that could apply to your household. As always, this is general in nature information videos. If you need specific advice, please speak with a professional. So what is the concept of debt recycling? You may have heard a little bit about this. It's a strategy when someone owns their own property with a owner-occupied mortgage and they're looking to strategies to reduce that non-deductible debt, being their place of residence home loan that they can't claim a tax deduction on, and optimizing their loans to ensure it's a bit more of a tax efficient strategy. So how does that work? So as an example, if a homeowner has built some equity into their property, and let's say they've bought their property for $1 million, they've started off with an $800,000 home loan and they're paying down that mortgage as they're going through that 30-year principal interest loan contract. And whilst they're paying down that loan, they've got surplus cash that they can now look to optimize. So paying down some of that debt further and using some of the equity to draw back out to invest for tax purposes and obviously claim a deduction on that interest. So we're looking at optimizing the mix between deductible and the non-deductible interest expense on your borrowings. So again, let's go through an example here. So we purchased a property for $800,000. Over time, we've reduced that down to $600,000 on the outstanding balance, meaning that they've got $200,000 in equity they could pull back out to invest in further property. Could be other income-producing assets such as ETFs, shares. And what we're doing is we're actually taking some of that portion of loan that we couldn't claim an interest deduction on, and we're changing the purpose of that borrowing. So changing the actual structure of why we're taking that borrowing back out. And so from a, how do we look at that from a adjustment point of view? So we are taking some of that additional cash or money we'll put into the redraw and we're cancelling out that facility. So we're reducing that and then we're taking out the same amount of borrowings. So when you look at it from a net point of view, your overall borrowings may not change, but you're actually changing the mix of the purpose. And that's the key here. We're trying to change the purpose of the borrowing, because if you look at the deductibility with the ATO and the rules, it comes down to, why did you look to borrow or take out those borrowings? What was the purpose of it? And for a lot of households out there, that initial purpose was for the family home to live in. That is non-deductible. So what we're trying to do is optimize your tax deductibility in terms of the loan purpose. And so with this sort of strategy, who's it suitable? Well, speaking to clients, it's definitely suitable for working families. So if we think about, if you're a family that lives in Sydney, Melbourne, Brisbane, some of those eastern state cities where they're working family household, they're paying huge amounts of tax on their personal earnings. They've got huge outgoings with their family owner-occupied mortgage, which is non-deductible, and they're looking at ways to change that mix to start claiming some of those interest deductions on investment purpose borrowings. And so it's going to be more suitable for those type of families where they are working. We've just had the stage 3 tax cuts were repealed by the current government. So that means that most families that are working, professional families in those cities, they are now paying more in tax than what they were due to pay a couple of years ago. So it means that if you do nothing, you just end up paying more tax to ATO versus looking at the optimization. And even if it's slowly over time, you're changing that mix, it's starting to get that benefit day by day. And so number one, I'll be looking at families with high incomes that can benefit from that. And also homeowners that have built some significant equity. So, if someone's owned that property for even a couple of years in a good location, because people are looking to buy into, blue chip areas where they want to live as a family. So quite often those areas have performed very well over the last couple of years. They've been paying down the loan, P&I. Maybe you've made some additional repayments into your offset account. So you're starting to reduce the interest charge. You're starting to bring down the principal owing on that loan. And so that means that we've got equity there that we could draw back down on to change that mix when it comes to this debt recycling strategy. And so who's it not suitable for? So if you've just taken out a loan, if you've got a high LVR, if you've got a 95% loan, that's not going to be suitable because we don't have the equity there to start this process with. On top of that, individuals that have a lower taxable income, so you may be starting your career, or even for people who are towards the end of their career, maybe their goal is to retire in 2 or 3 years' time. Maybe they've got some tax-free pension they're going to be drawing back on. This type of strategy is not suitable because if you don't have a taxable income, then really you're just shuffling the chairs on the deck of a ship. You're not actually changing your alt and financial goals here. So they're the type of individuals that this is not suitable for. So just keep that in your mind. And so to wrap up on that, what I would say, this is sometimes can be a long-term strategy, not something that you'll see a benefit from straight away. It could be something where you start to take a debt recycling. You might be able to take a second loan split for a small amount in year 1 today, and then you could add to that into the future. And so further to that, from a cash flow point of view, if someone's looking to use this strategy, you'd have an offset account attached to your existing non-deductible loan, which is what would have in place. And then on top of that, the income that we're generating from these investments, so if it's a new investment property that's been rented out, if it's shares that are paid dividends, we would look from a cash flow point of view to continue to direct that revenue into that offset account attached to your non-deductible loan, because then we're further reducing on top of your household income from your POIG or business. You're now starting to direct that cash flow against your non-deductible loan, and that's going to further accelerate paying down that non-deductible loan because we're reducing interest expense on that, and we're starting to increase that deductible loan. So of course, I would sit down with a professional, your financial planner, or particularly your tax accountant, to talk through these strategies. But this is a strategy that could be suitable for particularly working families in this country. Thanks, guys.